Good morning. This is Larry McMillan with a stock market update on Monday, September 9th. So the market has broken down again. It went into a trading range near, just below actually, the all-time highs, and it failed. It was in that trading range for a couple of weeks, and now it's broken down. It broke out of that formation, and then again on Friday had a pretty bad day. So the bears are starting to feel their oats again. There's heavy overhead resistance where that trading range was. It's between 55.60 and 56.50 up in that area. We did close the gap on that Friday downward, which could be a positive thing. But below here, there's support down to 53.70. If we were to close below 53.70, though, that would be pretty negative, and we would definitely have an extreme change of direction at that point. I believe a lot of selling would come in. So right now the market's trying to rally today, but we'll see if that has any legs or not. The McMillan volatility band buy signal is still in effect, although we have, as we usually do, we have rolled up positions that were in the money. The equity-only put-call ratios are still on buy signals as well. There's a bit of a technical thing there, but they are still on buy signals. The put buying has just not been that heavy on this most recent breakdown, which is a little bit surprising, but it is what it is. Breadth, however, has been extremely negative, and that has made our breadth oscillators roll over into sell signals, and that's where they are at the current time. They're pretty short-term indicators, so they can flip back the other way, but for now, they are bearish. New highs versus new lows is new highs have still been plentiful, registering nearly 200 new highs per day, a lot of that in small caps, but this is on New York Stock Exchange stock, so they're not that small. But now we start to see new lows increase in number as well. They almost reached 100 on Friday. So if new lows were to outnumber new highs for 2 days in a row, this indicator would revert from a bullish status to a neutral status. VIX itself rose last week pretty sharply, and on the first pullback, it gave us what we call a spike peak buy signal. So that's a bit in contrast with the trend of VIX, which is definitely upwards once again. And an upward trending VIX is bearish for stocks. So we'll just have to see how that shakes out. The trend of VIX is generally a more intermediate term, longer term indicator. The construct of volatility derivatives remains somewhat bullish. It's not as bullish as I'd like to see it, but it still we haven't seen an inversion in the term structure, which would be a pretty negative sign. So overall, the indicators are still somewhat mixed. We still have some bullish indicators in here, and it could augur for a bottoming process, but that overhead resistance now is very strong. That's going to be hard to get through that in the short term. A lot of people bought in that area figuring the market would go to new highs. And now that it hasn't, they'd be glad to get out even. So if it gets back up to that area, there'll be sellers, of course. In any case, I invite you to visit our website where we take a look at these indicators daily. And meanwhile, have a great week trading.